In June 2025, nearly 50,000 investors rushed to buy shares of HDB Financial Services, backed by the prestigious HDFC Group. The buzz was massive. Grey market prices had soared to rupees 1,300 per share. But just weeks later, those same investors are now staring at up to 48% notional losses. Was this a trap, a failure of regulation, or just a lack of investor homework? I'm going to show you exactly what happened, and more importantly, how you can protect your hard-earned money from falling into the same trap in future IPOs. Before we start, make sure to subscribe to this channel. We simplify complex investing stories and give you practical tools to invest smartly, especially when the crowd loses its mind. Let's dive into the 5 hard truths every IPO investor must understand, starting with the first. Truth 1. IPO pricing is not meant to benefit you. When you see an IPO from a brand like HDFC, the instinct is to trust it blindly. But here's the truth. IPOs are designed to benefit the seller, not the buyer. Take this. HDFC Bank's average cost of HDB shares was Rs 46. IPO price was set at Rs 740, giving them a profit of Rs 9,373 crore. Now let's compare it to the Zomato IPO in 2021. Investors were excited, but insiders were selling aggressively. Within a year, the stock fell more than 50% from its peak. It's a pattern. Early investors exit, retail investors enter. Lesson? Don't assume access equals advantage. If you're buying at IPO, you're already at the end of the value chain. Truth 2. Valuation must justify the excitement. Before the IPO price was announced, HDB's grey market value hit Rs 1,350 per share. People were bidding blindly on unlisted platforms, but when the IPO opened at Rs 740, a 40% correction panic struck. Why such a big gap? Because grey market prices are often emotional, driven by FOMO, not fundamentals. There's no regulation, no accountability, just hype. We've seen this before. In the Paytm IPO, grey market premium created a false sense of confidence. On listing day, the stock opened 9% down and kept falling. Here's the lesson. If the valuation doesn't match business realities, profits, asset quality, market share, then the IPO is not an opportunity. It's a mirage. Truth 3. Risks are hidden in the footnotes. HDB Financial looks great on paper. 19 million customers. Rs 2,175 crore in FY25 profits. But what hides beneath? Let's look at the fine print. 27% of their loans are unsecured. That means no collateral. High default risk. Added to that, RBI regulations will force HDFC to reduce its stake from 74% to below 20%. That means a flood of new shares may hit the market, pressuring prices. Their leverage ratio is 5.9x, high compared to peers. That's added risk in a downturn. Now remember, yes, banks fall in 2020. On paper, things seemed fine, until NPA numbers and governance issues piled up. Investors who ignored red flags suffered steep losses. Read the red herring prospects, not the headlines, because the real story of a company is not in its TV ad, it's in its footnotes. Truth 4. A great business isn't always a great buy. There's no doubt, HDB is a strong NBFC, diversified lending, presence in tier 2/3 cities, a healthy ROE of 14.7%. But as a value investor, we ask, what price am I paying for that growth? Even a great business becomes a bad investment if you overpay. Remember IRCTC, great company, monopoly. But when investors piled in at sky-high PE multiples, the stock corrected sharply. With HDB, you're buying growth that's already priced in. There's limited margin of safety. One shock, credit defaults, regulation change, and the downside opens up fast. What do smart investors do? They don't just buy businesses, they buy value. Truth 5. Timing access. Everyone thinks getting IPO allotment is a win, but the best opportunities often come after listing. Why? Because then you have price discovery, analyst reports, real market behavior. Let's revisit the LIC IPO. Initial listing was weak, but patient investors who waited and bought at lower valuations post-listing, they're now sitting on gains. Same could happen with HDB. If it corrects more post-listing and risk factors reduce, then it may be a compelling long-term bet. Your edge is not speed, it's patience. So what did we learn from the HDB IPO? It wasn't a scam. It was a case study in human behavior, valuation mistakes, and blind faith in brand names. IPOs are not shortcuts to wealth. They are tests of discipline. You protect wealth not by chasing trends, but by asking tough questions. You're not late to the party if you skip the IPO. In fact, you're probably the only one sober. If this video offered you a moment of clarity, consider tapping the like button. It helps guide this message to others who may be caught in the noise. Subscribe if you believe that investing should be rooted in awareness, not anxiety, in research, not rush. Each week, we share stories that help you pause, reflect, and invest with intention. Share in the comments. What's one IPO you entered with haste or wisely chose to let pass? Let's grow together, not just our portfolios, but our patience and perspective.